Hello, and welcome everybody back to the Millionaire Finance channel. Hope you're all having a fantastic day. If you haven't already, make sure you're subscribed and following. This channel gives you the real crypto intel before it hits the mainstream. The financial system is being quietly rewired right now, and 99% of people will miss it completely. 6 stories, one thread connecting them all. Watch every single one. Most investors are waiting for crypto to feel exciting again. They're waiting for the headlines, the hype, the dopamine. And that's exactly why they're going to miss what happens next, because the crowd is usually loud at the top and silent at the bottom. And right now, the silence is your edge. Let's zoom out. Markets move in cycles. Liquidity expands, liquidity contracts. Narratives inflate, narratives collapse. And in every single cycle, the best opportunities emerge when participation is at its lowest and conviction is at its weakest. In 2018, crypto was declared dead. The media buried it. Venture funding evaporated. Retail investors disappeared. Google search trends collapsed. It was quiet, painfully quiet. Then 2020 arrived. Massive monetary expansion, stimulus, zero rates. Liquidity flooded the system, and from that silence emerged one of the largest wealth creation cycles in modern financial history. The people who won were not the ones who waited for excitement. They were the ones who accumulated when nobody cared. Now flip it. Artificial intelligence is everywhere. Every earnings call, every podcast, every dinner conversation. AI stocks are the consensus trade. Capital is crowded. Expectations are extreme. Crypto, meanwhile, has drifted out of the spotlight. Fewer headlines, lower retail engagement, fewer viral moments. And that paradoxically is constructive, because markets reward positioning before popularity. That brings us to the macro backdrop, which is quietly turning in favor of risk assets. Again, the latest CPI report came in cooler than expected. Not once, not twice. 4 consecutive months below consensus. That's not noise, that's a trend. Inflation is decelerating faster than economists projected. And when inflation cools sustainably, central banks regain optionality. The Federal Reserve has one primary constraint: inflation credibility. If inflation is sticky, they must maintain restrictive policy. If inflation rolls over, they gain flexibility to ease. 4 straight downside surprises strengthen the argument that restrictive policy has done its job. And here's the key connection most people miss. Markets do not wait for rate cuts. They front-run expectations. As inflation data trends lower, bond yields begin to anticipate easing. Financial conditions loosen. Liquidity expectations shift. Capital starts reallocating from defensive positioning into higher beta assets. Historically, crypto thrives in environments where liquidity expectations are improving. Lower real yields reduce the opportunity cost of holding non-yielding assets. A softer dollar eases global financial conditions. Risk appetite expands at the margin. 4 consecutive cooler prints are not just economic trivia. They are signals that the tightening cycle is aging. Now layer in the policy narrative emerging from Washington. CNBC recently reported that lawmakers are targeting new legislation by spring. While much of the coverage centers on artificial intelligence, the broader signal is regulatory acceleration. When Washington sets deadlines, it signals priority. And regulation, contrary to popular belief, is not inherently bearish. Clear rules reduce uncertainty. Uncertainty suppresses capital formation. Markets price clarity. For years, digital assets operated in a legal gray zone. Agencies competed for jurisdiction. Companies navigated enforcement by interpretation. Institutions hesitated. That environment is shifting. Patrick Witt, a White House crypto advisor, stated openly that digital assets represent a new product that is somewhat threatening to community banks, GIPs, and larger institutions. Pause on that. When policymakers acknowledge that an innovation threatens incumbents, they are implicitly admitting it has structural relevance. Crypto is no longer dismissed as a fad. It is recognized as competitive infrastructure. And this is where the Clarity Act enters the discussion. The purpose of that legislation is straightforward: define what is a security, what is a commodity, and which agency regulates which category. Markets despise ambiguity. They reward defined rule sets. If digital assets receive a clearly delineated regulatory framework, institutions can allocate capital without existential legal risk. And once institutions have regulatory clarity, capital flows follow. If the macro environment is gradually shifting toward easing and regulatory frameworks are simultaneously moving toward clarity, you have a rare alignment. Liquidity tailwinds, legal certainty. That combination historically precedes expansion phases. But there's another narrative quietly evolving that matters even more. Bitcoin recently experienced one of its larger pullbacks of the year. Predictably, many commentators blamed ETF redemptions. The story was simple: institutions are selling. The trade is over. Then BlackRock CK's global head of digital assets, Robbie Mitnick, clarified that redemptions from their IBIT ETF were approximately 0.2%. 0.2% of 1%. That is statistical noise. In other words, institutions were not fleeing. In fact, the characterization shifted from speculative asset to flight to safety asset. That language matters. When the world's largest asset manager reframes Bitcoin as a potential defensive allocation rather than a casino chip, it alters portfolio construction conversations at scale. Narratives precede capital reallocation. If Bitcoin is increasingly viewed alongside gold in periods of uncertainty, demand dynamics change structurally. This is not about retail momentum. It is about institutional positioning. And when institutions hold through volatility rather than panic, drawdowns become consolidation rather than collapse. Now step back. Crypto is less popular than during peak mania. Inflation is cooling. Rate cut probabilities are rising. Regulatory clarity is advancing. Institutions are not exiting. This is what early cycle environments feel like. They feel boring. They feel uncertain. They feel quiet. That is precisely why they are powerful. But the most consequential shift may not be in Bitcoin alone. It may be in the architecture of global settlement itself, because while markets debate short-term price action, something much larger is unfolding beneath the surface. Over the last decade, the global financial system has been fragmenting. Geopolitical tensions, trade realignments, sanctions regimes, regional blocs asserting monetary independence. The BRICS framework expanded. Western alliances recalibrated. Cross-purse settlement became a strategic tool. Against that backdrop, there have been reports of renewed economic coordination between major economies, including discussions involving the United States, BRICS nations, the UK, Japan, and the European Union. Whether those negotiations evolve fully or incrementally is less important than the structural implication. Global trade corridors are being redefined. Settlement infrastructure becomes critical in that environment. Historically, cross-border payments relied heavily on correspondent banking networks and legacy messaging systems. These systems are functional but slow capital and opaque. Now consider Ripple. For years, Ripple has focused on building institutional-grade settlement rails through the XRP ledger. Russian banks reportedly experimented with XRP pilots as early as 2018. Indian financial institutions have tested blockchain-based corridors for cross-border settlement. Early experimentation between Asian and BRICS-aligned institutions explored distributed ledger interoperability. Japan has long been one of Ripple's strongest jurisdictions, with extensive banking partnerships and regulatory engagement. European regulators have increasingly developed comprehensive digital asset frameworks. The UK has advanced its own crypto regulatory pathway. Singapore's monetary authority granted Ripple a payments license in December 2025. Across Europe, Ripple holds dozens of regulatory approvals enabling compliant operations. Individually, these developments appear incremental. Collectively, they form a latticework. Infrastructure does not announce itself with fireworks. It expands node by node, corridor by corridor, license by license. Now, layer and XRPL's evolution toward permission domains and identity-linked credential systems. Central banks require compliance. They require KYC integration. They require controllable environments. Permission domains allow institutions to operate on distributed ledger infrastructure while maintaining regulatory guardrails. Zero-knowledge prudential systems enable identity verification without sacrificing privacy. This is not ideological decentralization. This is regulated interoperability. And here's the structural pivot. If Ripple were to secure a US banking license, it would not simply be another crypto company with approval. It would become a regulated dollar gateway. Stablecoin infrastructure such as RLUSD could function as connective tissue between traditional dollar liquidity and blockchain-based settlement rails. In that configuration, nations remain $L while transacting over digital infrastructure. Settlement speed increases, capital efficiency improves, transparency expands, compliance remains intact. That is not a speculative fantasy. That is a design architecture. Now connect the macro dots. If global trade corridors are rebalancing, if institutions are seeking faster, cheaper, and compliant settlement mechanisms, if regulatory clarity is emerging in major jurisdictions, if the United States is simultaneously considering policy frameworks that legitimize digital assets, then the infrastructure layer becomes critical. Ripple's positioning is not about retail hype. It is about institutional plumbing. And plumbing is rarely glamorous. It is essential. This is why the popularity metric matters. Retail enthusiasm often peaks after infrastructure has already been built. In the early stages, only specialists pay attention. Meanwhile, inflation cools, rate expectations shift, and liquidity begins its slow turn. Imagine a scenario where rate cuts begin within the next year. Liquidity expands modestly. Risk appetite rebuilds gradually. Institutions increase exposure to digital assets within a clarified regulatory framework. Bitcoin holds its ground as institutions reframe it as a macro hedge. Ethereum continues evolving its settlement ecosystem. XRP, positioned within cross-border institutional flows, benefits from corridor expansion. That is how cycles compound not in a single explosive headline, but through the alignment of macro liquidity, regulatory clarity, and infrastructure readiness. Short-term volatility remains inevitable. Markets will oscillate around data releases. CPI prints will surprise in either direction. Employment reports will shift rate probabilities. Headlines will exaggerate minor developments. Crypto will continue to experience drawdowns and rallies. But structurally, the environment is improving. Cooling inflation reduces policy constraint. Improving regulatory clarity reduces legal risk. Institutional reframing reduces narrative fragility. And global settlement realignment increases infrastructure demand. Long-term, this is about tokenization. Capital markets are migrating toward on-chain representations of value. Bonds, equities, commodities, stablecoins, all increasingly digitized. Global liquidity will not remain static. It will seek efficiency. Distributed ledger infrastructure offers atomic settlement, reduced counterparty risk, and programmable compliance. That is not anti-bank. It is post-legacy. Institutions do not disappear in technological transitions. They adapt. Community banks may feel threatened. GSIBs may resist, but eventually the competitive landscape forces integration. Just as the internet did not eliminate commerce, but digitized it, blockchain will not eliminate finance. And the rewiring is happening quietly. Most people will not notice until it becomes obvious. By then, popularity will return. Headlines will scream about new highs. Retail will re-engage. Dinner conversations will shift back to crypto. Search trends will spike. That is usually when risk is highest. Today feels different. Today feels underowned. Today feels early cycle. And early cycle environments reward patience and positioning, not euphoria. In the short term, expect choppiness. Markets are forward-looking but data-dependent. One hotter inflation print could temporarily reverse rate cut expectations. Geopolitical headlines could create risk-off episodes. Crypto-specific volatility will remain elevated relative to traditional assets. But watch the trend, not the noise. If inflation continues its downward trajectory, the probability of policy easing increases. If policy easing becomes consensus, liquidity expectations strengthen. If liquidity expectations strengthen, risk assets typically benefit. What regulatory milestones, movement on comprehensive crypto legislation would signal institutional green lights? Additional banking licenses or cross-border corridor expansions would confirm infrastructure momentum. Watch institutional language. When asset managers discuss digital assets in terms of portfolio diversification rather than speculation, it reflects deeper integration. Long-term, the thesis is simpler. Global finance is digitizing. Liquidity is cyclical. Regulation is maturing. Infrastructure is being built. The crowd is distracted, and that distraction is opportunity. The financial system is being quietly rewired right now, and 99% of people will miss it completely. 6 stories, one thread connecting them all. Crypto is not exciting because it is not crowded. Inflation is cooling, granting central banks flexibility. Legislators are moving toward clarity. Institutions are holding rather than fleeing. Global settlement corridors are modernizing, and infrastructure players are positioning for a world where value moves as seamlessly as information. You do not need fireworks to recognize a turning point. You need perspective. If you wait for the crowd to confirm it feels safe, you will likely be providing liquidity to those who positioned earlier. Silence is uncomfortable. It lacks validation. But historically, silence has been where asymmetric opportunity begins. If you found value in today's breakdown, don't forget to like the video and subscribe.